Hey guys, welcome back to Crypto Studio 247. My name is Ty, and in this video, we will be sharing with you some thoughts on one of the brightest minds in the 21st century, Chamath Palihapitiya, and his thoughts on the current conditions of the cryptocurrency space and the traditional financial markets. Enjoy the video.
And everybody starts to throw out this whole thing, which is, oh my God, you can never slow growth and the company will die. And yeah, maybe in a vacuum that's true. But when every other company is fighting tooth and nail to survive, the only thing that you need to do is actually survive. By surviving, you win. If you can basically make your cash last as long as possible, even if you cut to the bone and stop growing, if you come out the other end and you're the only company that's left, you will win and run over the market. You may have pushed to the right a few years your plans of world dominance, but they're still available to you. We still had some amount of rate uncertainty from the Fed. I think people weren't sure how aggressively they were going to hike. But by early this week, it was pretty clear there's going to be two 50-point hikes, one in June and one in July, and then effectively a pause, because then the Fed funds rate will be at around 2%. And everything from there will probably be path and data dependent. Now, I think the markets had actually already started to see that writing on the wall. So if you go back to, one of our favorite measures, which is the 10-year break even, it's effectively rolled over, which means that from the highs in sort of late April, it started to come down, which says that, they were thinking that the inflation was not going to be as bad in the back half of the year. And then the second is that corporate credit, which is really what matters in some ways to the Fed, because that's where they can intervene. What is the spread above treasuries that a company can issue debt? When it goes crazy and it goes up, it means, oh no, the cost of capital is going up. That's going to be hard for companies to raise money. They may have to lay people off. They may need to get into cost-cutting mode, right? That's what goes through everybody's mind. But that's also now about 35 and 40 days rolled over, which means that the gap has started to shrink, between the US Treasury price and what, decent corporates can issue debt at. So it looks like we are set up for potentially a decent little rally here. The problem is it a rally that is sustainable, or is it a rally that's basically what we call a dead cat bounce or a bear market rally, where, you just get some 1 or 2 weeks of relief before the thing spears down again? And there is the potential, if this data comes back as reasonably good, which means prices are, not escalating as much as we thought, inflation is not going to be as bad, growth is going to be moderate, that gives a lot of ammo for the Fed to kind of take their foot off the gas here. And if that case, the markets will go boom. I think we're in a pretty reasonable place here. The real question is now, what do you need to take the market lower? And this is more of a nuance, but when you look at companies that are now quote unquote cheap, right? Let's take an example like Google or Facebook, right? And people will say, my gosh, this is cheap, because if you run a screen on it, it's like 10, 11, 12 times price to earnings. Well, the price because you can look on the screen. The real question is, are the earnings right? And the thing that can take the market lower is if you actually think earnings are modeled incorrectly, right? So we saw this week as well, Snap completely just blew themselves. They have the most incredible propensity to self-immolate on earnings calls than any other company I've ever seen. There's probably been 3 times, no less than 3 times over the last 4 years, where I don't know whether it's just poorly scripted or not well rehearsed, or the people that are helping Evan get ready for these things, but these are disastrous calls. My point in telling you this story is that if you think Facebook and Google, just as an example again, are cheap at 10 times, well, you better hope that the earnings are right. Because if the earnings are actually wrong, that's actually 27 times and 19 times. I'm making these numbers up to give you the example, because the earnings are fundamentally wrong. So that's the risk now that's left in the market, in my opinion, that could take it much, much lower, is if that, all of this slowdown really contracts spend and the earnings are actually not accurate. The forecasted earnings will need to be revised over the next 2 or 3 quarters and that's where we will probably see the low. If, however, growth is muted and the Fed can, as Brad said, it's a really good analogy, now just course correct by degrees, a degree here, a degree there, we've probably consolidated the lows. I think there's still going to continue to be examples of folks who basically run themselves into a brick wall because they don't want to make the hard decisions. That is going to be more exaggerated in Silicon Valley because we have a culture of tolerance and we have an economic business model that supports kind of irresponsible decision making and supports poor governance. But a fund's job, ultimately, is to make a very important decision about whether they truly care about generating massive returns or whether the fee income becomes so meaningful so as to drown out every other incentive that they have. The idea that over the last 4 or 5 years you optimized for anything except the market beta was kind of dumb. And the worst thing that you could have done in that period was confuse alpha and beta, meaning alpha is what you are able to do because of your discrete skill versus anybody else. Beta is when just the market goes up. And I think that a lot of folks were made to feel very silly or, a downer or a wet blanket in these last few years who will probably have the last laugh. You're saying something that I think is also important that's not really talked about, which is that there's going to be a lot of really good companies with really horrible capital structures, really terrible cap tables, really bad valuations, really big overhangs of preference stock that are going to have to get worked out. And in getting that worked out, going back to what Brad said, the person that course corrects 90 degrees will win. And the reason they'll win may not even be because they're being that courageous, they're just being less stupid than everybody else, quite honestly. Because you have to remember, in most of these markets over the last 4 or 5 years, we funded 4 or 5 versions of every imaginable company. And then there's going to be a marginal second kind of also ran that captures some value, and everybody else is not that valuable. And, that's roughly been true. But the reason we were able to support that was that every company looked kind of interesting. Anyone with traction could be, competed against because the only differentiator at the time was very cheap money that was effectively free and it was flowing in, faster than you could count. So all of that has to get sorted out. So I just think that those dynamics shouldn't be ignored.
Wow. If you enjoyed this video as much as we did, please give us a like and let us know in the comment section what you think about Chamath's comments on the current state of the financial markets. Make sure you subscribe to our channel for daily cryptocurrency coverage. A video every day providing you with opinion, news, and analysis. Check on the notification bell so you can see our new videos as soon as they are uploaded. Smash up the like button, leave a comment below, and we will see you tomorrow, friends.